Dave Ramsden, Deputy Governor of the Bank of England. Dave, very nice to have you on the programme this morning. I'll focus in on the UK in our conversation, certainly initially. And I want to ask you about growth forecasts, because the Bank of England is forecasting no growth for the UK economy in 2024, but the OBR forecast, I think, is for 0.7% growth. I wonder what you think explains those kind of divergences and uncertainties about the UK outlook for next year.
Well, thanks, Anna, and it's very good to be able to join you from Hong Kong and to start by talking about the UK economy. And what we've seen so far this year in terms of growth is actually more resilience than we were expecting. So there was positive growth in the first half of the year, but we've seen zero print for growth in Q3. And our forecast is that growth's going to continue to flatline as restrictive monetary policy continues to bear down on demand. I think the OBR have a pretty similar profile for growth. They do have growth picking up more strongly next year, but still really quite subdued.
OK, and just on that contrast with the OBR, I understand that you have a slightly lower speed limit in your thinking around the UK economy than the OBR does. So the level at which growth can get to before it comes inflationary, I think you're at about 0.75%. They have a higher number. I appreciate it rises over time, but why do you think you take that view?
That is a really important part of our forecast, and also I think one of the factors, as I've been saying here in Hong Kong, that distinguishes us from other forecasters. We do have weak growth in potential supply, or if you like, the speed limit at which the economy can grow without triggering inflation. And that's really borne out of the analysis that we've done of how the economy has performed in recent years. Had very weak productivity growth on the ONS's latest experimental series. I think there was zero productivity growth in the year to Q3. And also we've been highlighting for some time the fact that labour supply has been weak, in the sense that the number of people participating in the economy is actually still, in terms of inactivity through sickness, lower than pre-COVID. So that's another supply side factor. And a third one would be that we think there are signs that the equilibrium rate of unemployment might have gone up a little bit in the recent past. The matching between the jobs available, vacancies, and workers looking for jobs, we think may have deteriorated a bit. So all of those factors give us this weak potential supply outlook, this weaker speed limit. Those are judgments, and I think the OBR probably have taken a slightly more positive view on some of those judgments, and time will tell.
OK, time will tell. Time will tell around services inflation as well, but you do seem to think that services inflation is going to be sticky. What are you seeing that worries you when you talk to people around the country? What is it you're seeing in that particular dynamic?
Yeah, and that's a really important point about the outlook for inflation. I gave a speech actually at Bloomberg week before last, and I highlighted that actually our headline inflation forecast, this is the MPC's headline inflation forecast, had come in this quarter very much in line with what we were forecasting a year ago. So inflation was 4.6% in October and is going to be under 5% for the quarter as a whole. So inflation is less than half what it was a year ago, but that's been driven down by a bigger fall in the energy component than we were expecting. But meanwhile, services, which makes up 45% of the consumer basket that makes up the CPI inflation number, that's actually much stickier and higher than we were expecting at 6.6%. And so that's really a sign that UK inflation is becoming much more homegrown. And we think that that inflation is going to be really challenging to squeeze out of the system. It's driven by wages, where wage growth remains above 7%. The service sector in the UK is very labour intensive. So, these factors are what's leading to us think that inflation is going to stay stubbornly high through next year, which is why on our
that
forecast,
explains the services outlook.
Monetary policy is going to have to,
So can I go on and ask you about other dynamics around inflation then? We recently heard from the government, of course, and £10 billion worth of tax cuts. Is that going to add to inflationary pressure, Dave? Is that how you view those tax cuts?
Well, when we put our last set of forecasts together, which I've been talking about back in early November, we didn't know what was in the autumn statement. So we'll have a first chance to look at what's in the autumn statement in terms of what it means for the outlook when we have the MPC round in December. When I get back to London next week, we'll be starting on that round, but we'll be incorporating it formally into our forecasts next February. And one thing we'll be able to look again at is, particularly the evidence of more persistence in inflation, services. As you were saying earlier, we'll be able to also talk to businesses around the country to see what they're seeing in terms of the persistence in inflationary pressures. And it is in services inflation that we see the most risk of persistence, the most risk of stickiness.
Can I ask you about the Table Mountain analogy? At the Bank of England, you've set out this idea that this helps to explain how rates will stay high for a period. I know everybody's trying to work out how long that period is, of course. You've said today that it'll take 2 years to get inflation back down to target. And you're part of a number of sort of hawkish messages, relatively hawkish messages, I suppose, versus the market that we're hearing from the Bank of England. Is that a concerted communication effort? Do you think that the market is overly pricing in rate cuts for next year?
I can't speak for whether it's a concerted communication effort. Certainly from the perspective of the Monetary Policy Committee, we do want to emphasise that based on where we see the economy going as of now, based on our current forecasts, we think that monetary policy is going to have to stay restrictive for an extended period. We've had bank rate now at 5.25% since our August meeting. We'll be able to return to the decision in December. But certainly given the risks that we see in terms of the persistence of UK inflation, as you were saying, on our forecasts it takes a year for inflation to come down from 4.6% to 3% at the end of next year. And then it takes another year on our most likely or modal forecast for inflation to get down to 2%. But we see upside risks, and so even at the end of 2025, our mean or average forecast is actually just above our 2% target. But I guess I would stress that this is based on the forecasts that we presented, and as we always want to stress, we're not making any kind of commitment to where interest rates will be. We're saying that conditional on the outlook for the economy, we think that monetary policy is going to have to stay restrictive, interest rates are going to have to stay high for an extended period. But that's a data-dependent point, and we'll be able to review our forecasts against developments.
Thanks so much for joining us. So Dave Ramsden, the Deputy Governor of the Bank of England, thank you for your time, joining us there from Hong Kong.